Joshi ji, Professor Warwick, McKibbin, I'm not very sure I'm pronouncing correctly, but please pardon me if I'm mispronouncing. And of course, Dr. Biswajit Nag and other distinguished people who have joined on this. Today's uh, webinar topic is very, very interesting, contemporary, and if I can use the word, it's a burning topic. Therefore, it arouses the interest of one and all, and whether you are an economist or a politician or a sociologist, be any field, it arouses the interest of people at large. So therefore, this assumes added importance of this particular webinar and impact of US tariff on India and Asian countries. Now, let me set the tone. US tariff policy have significantly reshaped trade flows across India and Asia. In 2025, US duties on Indian goods rose to about 50%, contributing to reported 22% fall in India's export to the US in early 2026 or 25 even, and widening trade pressure before being reduced to roughly 18% under a new interim deal. And my understanding, it has not yet come into effect as of today, as we are discussing. So it may come in a month's time or whenever on the 1st March. So across Asia, differential tariff treatment has altered the competitiveness. And these shifts highlight supply chain diversification, regional competition, and growing strategic role of trade diplomacy in shaping Asia-US economic relation. In the webinar, the panelists we discussed how US tariff may reshape trade flow, alter global value chains, and influence export competitiveness across the region. I think expert will delve more on this because this is a very, very sensitive and interesting subject. And before I open the floor, give the floor to the chairman, let me introduce our chairman and other panelists, though all three who are going to speak today mainly are well known, but even it is a requirement of our to be formally introduced. So Professor Rakesh Mohan Joshi is the Vice Chancellor at Indian Institute of Foreign Trade, and this is a premier B school under the Ministry of Commerce, who is the think tank of the Government of India. And Professor Joshi is a senior professor and former dean at IIFT and was on deputation to Indian Institute of Plantation Management at Bengaluru, and as director. Professor Joshi is a gold medalist from IIFT, received his education and training from Harvard Business School, Boston, and he also got from Rajasthan University. He was with the National Dairy Research Institute, Karnal, which is a premier institute. He authored highly popular books from Oxford University Press and had been an editor of the prestigious quarterly journal of IFT, Foreign Trade Review, which is very, very well led, and citation is very, very big. Professor Joshi has an extensive transnational exposure and has been associated with several multilateral organizations such as World Bank, ADB, UNCTAD, International Dairy Federation, Asian Productivity Organization, and just to name few. Professor Joshi has been the chairman of UGC committee also for framing the regulation for foreign educational institution and chairman of expert group for development of educational framework for global citizenship for higher institution. Presently, he is also the chairman of Business Service Sectional Committee, Bureau of Indian Standard, Government of India. He is also on the Council of Management, All India Management Association, and he has a strong inclination to research internationalization of Indian culture and has carried out a major research project on implication of Bhagavad Gita in contemporary management by Indian Council of Social Science Research. So look at this wide experience. He has a depth as well as the width also in his diversification. So we are grateful to him. for having spared his time to be with us today on our webinar. Now I come to Professor Warwick McKibbin. Is an emeritus distinguished professor of economics and public policy and director of Center for Applied Macroeconomics Analysis at Australian National University. He is the CEO of McKibbin Software Group Private Limited and a non-resident senior fellow at the Peterson Institute for International Economics. He is a distinguished public policy fellow of Economic Society of Australia, a distinguished fellow of Asia and Pacific Policy Society, and a fellow of Center for Economic Research, London. He earned his PhD in economics from Harvard University in 1986 and a Bachelor of Commerce first class honors and University Medal from the University of New South Wales in 1980. He served on the board of Reserve Bank of Australia, which is our akin to our RBI in India. So just to give an idea, and previously he worked on his staff as well. He was also a senior fellow at the Brookings Institution, and he was awarded the Order of Australia in 2016, almost 10 years ago, and the Centenary Medal in 2003. He is internationally recognized for his work on global economic modeling, monetary and climate policy, pandemic economics, with over 250 academic publications and 6 books. So this is a short list I am just saying, but the list can go on. Now I come to Dr. Biswajit Nag. He is a professor of economics at Indian Institute of Foreign Trade, again under the Ministry of Commerce of the Government of India. He is involved in empirical economic research for close to 2 decades. He has also been teaching. He has teaching experience in India and abroad. Earlier, he served the Poverty and Development Division in Escape, Bangkok. Dr. Nag has completed number of projects for Government of India and international agencies such as UN, World Bank, ADB, WTO, DFID. It's a list is long. And Dr. Nag's current research interest is in international production network, global value chain, trade in services, and regional trade agreement, trade and development. He also has expertise in developing sector-based strategy, which is very, very challenging in accessing international market and analysis of consumer behavior. Again, it arouses a lot of interest from academia and industry. He has published articles in number of international journals and also served as anonymous referee to several reputed journals. Dr. Nag is currently working on trade and technology with a focus on firms' ability to absorb new technology and accelerate its involvement in international trade. He is also conducting research on technology integration and employment in Indian exportable sector. With this brief introduction of 3 esteemed and distinguished panelists, including the chairman of the session today, I hand over the floor to chairman of the session, Professor Joshi. Over to Professor Joshi.
I think you're on mute, Professor Joshi.
Okay. Thank you so much, Professor Ashok Vishandas ji, and thank you so much for our distinguished guest, Professor Warwick McKibbin, who is joining from Australia. And thank you so much for being with us, and my colleague, Professor Biswajit. So I am in company of, very high intellectuals today on a topic which is, very, very important, very, very pertinent. And everybody today is talking of the impact of the US tariff in whatever countries we are, because I think, the way the whole world trade was going on, the US tariff have absolutely unsettled the traditional theories of economics, wherein, free trade and opening up of the countries was being, promoted by the countries. And, for the last so many years, over 70, 75 years, when the UN organizations like GATT and then WTO, they primarily focused on, decreasing the tariff and reducing the trade barriers between the two nations. And free trade so far has been said as a, as a panacea for all, and, that was considered to be a tool for all economic growth. So all countries reduced the tariff, and US reduced the tariff from 19-20% 100 years ago to 3%, no, 2.5 to 3%, till very recently, till 25. But it was only after President Donald Trump came to the power that US tariff in the last 8 months increased. Average tariff from 3% to 19%. So it's a major, shift in the trade strategy for the biggest economy of the earth with 30 trillion US dollar, and the shift in the US tariff, structure and their policy and the strategy to impose the tariff. Had a big impact on the global supply chains. Products from some countries became more competitive in the US market. Products from other countries became, more competitive in the other market. And the economy of US is so big that, the 30 trillion US dollar economy is bigger than the next 5-7 economies on the earth. So it's very big. So big market. For India also, US account for 21-22% of our, export market. So our dependence on US is 1/5 of the total market. Then what happened is the US, the new concept has come is the reciprocal tariff concept. So the concept which was abandoned 100 years before by the whole world, it came again. And it came again. India incidentally faced 50% tariff. 50% tariff in India was probably the highest on the earth, other than Brazil, which also faced 50%, and Canada also for some period also faced 50%. But our competitors, especially in the product in which I think we have got a large market for US, 30 to 45% of the market for our textiles, ready-made garment, leather, is America, and this faced reciprocal tariff of 50% and plus MFN tariff of 12 to 14%. So total putting our tariff to 60 to 64%, making our product very, very uncompetitive in the US market. And because we don't have an alternative market for this, or difficult to find alternative market in the short term, it impacted the industry. So I think there are multiple things we have got experts to listen from, but our neighbor Bangladesh had 19% tariff. Pakistan also, so Pakistan also 19%. Then tariffs were reduced for Indonesia and Vietnam. So India was badly hit. But very recently, the 2nd of February, we reached an agreement or something, an understanding with the US for immediately, reducing the tariff to 18% from 15%. It has absolutely, benefited a lot of industries, benefited labor-intensive industries, especially ready-made garment, textile, leather goods, and shrimp and the marine products. So it has had a positive impact. There has been certain criticism as well. So I am very sure we have got experts, and the tariff on one country impact the tariff on other countries as well. So it disrupted and create and facilitated newer supply chains. Then there has been, long conflict between China and the United States of America and maybe many other countries. So countries were looking at China plus one strategy. So this 18% tariff would also, facilitate us. But again, something which is very predictable about United States of America is its unpredictability. So 18% till what extent it remains. We are having a lot of threat also because, again, that buying oil from Russia, having trade with if you buy oil from Russia, 25% tariff. If you also have any trade with Iran, then again 25% tariff. And there are many more things going on. So to deliberate upon all these things, that what is the the tariff on India and other Asian countries and how it impacts India and maybe other countries. So for this, I think I invite Professor Warwick McKibbin. So thank you so much for being with us. And we are highly privileged to listen from you. He is a high-class intellectual of international repute. So thank you so much, Warwick. Looking forward to listen to you. Warwick.
Thank you very much, Professor Joshi. I'm going to share my screen and hopefully this will work.
Please, please.
Could someone please confirm that you can see my presentation?
Yes, I can see.
Yes.
Please go on.
Great. So it's a great pleasure to be here with for EGROW Foundation presentation. What I'll talk about today is a very vast topic, as Professor Joshi just pointed out. It's part of a project at the Peterson Institute that actually began before the US election. The first paper we wrote with Marcus Nolan and colleagues was to look at what happens if President Trump won the election. And we considered in that first paper tariffs, the uniform tariffs on all goods and services. We considered deportation of between 1.4 to 8 million workers, undocumented workers. We considered what happened if the Fed independence was undermined. As it turned out, that paper is still valid. It's still interesting. Some of the tariffs are very different to what was implemented, but the basic economic story is still the same. We've been updating this project. The idea was to update it whenever there was a new tariff announcement. Obviously, that became impossible because there was a new tariff announcement every hour, in fact. And so there are a couple of key papers where we took a snapshot of the tariff situation at a point in time, and I'll be drawing on those presentations. What I'll talk about today is, firstly, what do we learn from these scenarios for the impacts? When I say the latest US tariffs, it will be a snapshot as of September 11 last year, because it's just impossible to keep track of the daily changes. And we also want to focus on what happens if countries retaliate versus not retaliating to these tariffs. If there is time, I also want to talk about a very important policy if people lose confidence in the US economy. That has very significant trade implications, exchange rate implications, and global capital flow implications. There's a lot of this material is actually available on the website documentation.gcube.com. I'm going to try and actually access that live. If it doesn't work, please let me know. Can you see a website? Can someone confirm?
Not yet.
Maybe I have to reshare. Let me just reshare that. Okay, okay, it's not going to work. So luckily I've created the slides. If you go to the documentation.gcube.com website, we have all the documentation on the model that I'll be talking about. We also have all the results for the different tariffs at different points in time. And you can download the results for any country and sector, particularly the India one, which I'll be presenting today, from that public good that we've developed. Policymakers around the world have actually been using this material for creating policy responses to the Trump administration. Can I just double check again that you can see the G-Cube model slide?
Yes, we can.
Okay, so the model we're using is the G-Cube model. It's published in the Handbook of CGE Modeling. It's a very complex, very large CGE / dynamic general equilibrium model. I won't go into much detail except to say we're modeling individual countries, and we look at the behavior of households, the behavior of firms, behavior of governments. We have central banks. We have production structures, so we use the input-output structures of different countries, of production processes within countries and across countries. We model the international trade and financial flows, and the agents in this model are partly forward-looking and partly backward-looking. So we're modeling in individual economies how households behave, how firms behave, how countries interact with each other, and we can draw some implications both from a policy evaluation point of view, but also in understanding the complexity of the tariff structure. and the policy responses. So there are many different versions of the GQ model. The one that's most widely used and which I'll be drawing from in these results is the G20 model. And what we're modeling in the G20 model is we model 19 countries, including India, 5 regions, and then within each country there are 6 sectors of production: energy, mining, agriculture, durable, non-durable manufacturing, and services. So as you can imagine, this is a very large model. It's also, for people that are interested in more complex focus on Asia, the model we developed for the World Bank for version 6W does have a very different country disaggregation within Asia. The results between these two models for the same tariffs are slightly different because we're picking up different country linkages. But basically, I won't talk about this degree of disaggregation. I'll focus on the one that's had most international attention. So what we're doing then is we solve the model projection of the world economy if there is no trade war. And then we ask the question, what if there's a particular set of tariffs announced at a point in time? And the key assumptions here is that people believe the tariffs will be permanent. And it's very different if you think they're temporary. We can analyze that, but in fact, for the presentation, I'll be doing permanent tariffs. The tariff rates we're using were calculated by Chad Bowen, my colleague at the Peterson Institute. It's very complex because there's different tariff rates on different line items for different countries. It's really important that it's not just what tariff is imposed on India, it's what tariff is imposed on India relative to other tariffs in other countries in the US market, but also how all the production networks that India is associated with, how the tariffs permeate through, both in terms of quantities and prices. The key thing that we discovered when we started doing this work is that the actual tariffs are much lower than the headline tariffs, and that's particularly true when you look at Canada and Mexico. A lot of side deals have been done, a lot of exemptions have been given, and so it's very, very difficult to actually get the actual tariff rates themselves. So what Chad has done is that the 6-digit classification of trade, his team has built up at a tariff rate at the sectoral aggregation within the framework that we're using. And again, as I said, this is effective as of the 11th of September last year, and there's been a lot of changes since then. So the snapshot again is 11th of September. For anyone who actually saw the original work, there's 2 key differences between the work we did before President Trump won the election and the current set of tariffs. Firstly, these are not uniform tariffs. Particularly, there are tariffs on goods. There are no tariffs on services. And that's a very important story for the results for India, because the services are not being tariffed. The results are very different to a uniform tariff. Also, each country has a different treatment by sector. And actually, surprisingly, Canada and Mexico have gone from very high tariffs to quite low tariffs. How do tariffs work in this framework? A tariff creates a gap between the price paid by an importer and the price received by the producer in the exporting country. If the exporting producers don't adjust their prices, then the price paid by US firms that are importing for intermediate inputs and households will go up by the size of the tariff. The revenue will go to the government, the US government. Who pays depends very much on the elasticities or the responsiveness of sellers versus consumers. In our model, 90% of the tariff passes through into the price of goods within the US economy. This is very consistent with recent data from the New York Fed and from other researchers. It's also consistent with the tariff war between China and the US in 2018-19. So this is very much a price impact on imports. It's a cost impact on companies that are importing goods from overseas as part of their production process in the US economy. And this production network effect turns out to be very, very important. So again, I cannot explain the whole model in such a small amount of time. The model is fully documented. All the equations are available on the website. All the results are available on the website, and the analysis of the parameters that are being used, everything is open source and public domain. What I present to you now then is an insight into how to think through these results. And so again, we project the world economy, we impose a tariff, and we look at the difference between the world with the tariff and without the tariff. So all the graphs will be deviation. In other words, if a variable is 0, it means that variable hasn't changed as a result of the tariff war. Now, this is a snapshot, and again, this is just a snapshot at a point in time. These are the results for the change in GDP from US tariffs in 2026, so that's this year now. The tariffs are announced in 2025, so I've just plucked 1 year, but I'll show you some dynamic stories in a minute. So you'll notice that the biggest impact is actually on the US economy itself. So tariffs increase the cost of inputs, they increase the cost of final consumption prices. It causes a slowdown in the US economy. It doesn't cause a recession. Again, this is deviation from base. So if the US was going to be growing at, let's say, 2.5%, this says that the US economy will be 0.8% lower, which means it'll grow by 1.7%. So it's not a recession. The biggest impact is on Canada and China in this case. China's tariffs are actually very large in this scenario, and you can actually see the tariff numbers we're using at the website. It's different by sector, by country. It's less for Mexico than it was in the original round because of the USMCA exemptions. The impact on countries like Australia is interesting. The impact of the US tariff alone is positive for Australia, particularly Australian agriculture, because we pick up relative market share relative to other exporters to the US economy, but we get a negative hit because China slows down and China's demand for Australia's iron ore and other resources goes down. And so the spillover effect from China is actually bigger than the effect in the US. Notice that India, we get this slightly small positive. And again, we'll go through this in a bit more detail. And so it's not completely clear that tariffs hurt everybody. They hurt certain sectors, they hurt certain countries. And it depends on the linkages with the US economy and the linkages with all the economies that are affected by the tariffs. So the complexity here is why you need to use a very large scale economic model to unpack the effects. So let me go through very quickly the key insights. And again, obviously the quantity of numbers, the scale, will depend on assumptions about responsiveness, elasticities, a whole range of assumptions, but these are this model's been widely used for the last 30 years. It's used in central banks around the world. It's used in international organizations like the IMF or World Bank and others. But this is just to give you an idea of the direction of change. And I would argue that the magnitudes are actually plausible. So this is what happens to the US economy. Now, in all these charts, what we did was we've got 3 lines in each chart. When we did the original tariffs in Liberation Day, we did not know what the tariffs were going to be. So we did a low scenario and we did a high scenario. So that's from the study that we did in April 2025. The new study is what you get from the tariffs as of September 11, assuming that all countries retaliate the way that they said they would, right? And so the idea of having 3 lines here is to show the range of uncertainty between the original Liberation Day tariffs and the actual tariffs as of September. And you can see that the imports, as you'd expect, you increase the price of imports by putting a tariff on. That causes the demand for imports to fall. This is percent of GDP deviation. So the range is between 2% and 3.5%. The tariffs as of September are at the high end in terms of the impacts. What happens to the trade balance? Well, there's an ambiguous, there's an open debate. Would the trade balance improve or worsen? What happens for the trade balance depends on what happens to savings versus investment. So when you put on a tariff, if investment goes down and your savings doesn't change, then your trade balance will improve because capital will flow out of the economy, the US dollar will depreciate, and you'll end up with a trade surplus. So one of the key features of this framework is that it's savings and investment that determines the current account and the trade balance. The composition of exports and imports will be determined by income and relative price changes. So this basically says that upon announcement, you expect to see an improvement in the US trade balance. Again, there's a range there because the tariffs range, but you'll see that by the time we get to the 2030, there's not very little impact on the trade balance. So if the idea or the focus of the Trump administration is to improve the trade balance, it's only a temporary phenomena, and there is enough empirical evidence that says that these results could actually be negative in the short term, depending on parameters, but this is the key parameter of the model. What happens to GDP? Well, again, interestingly, the first year effect, what I showed you before was the second year effect. In 2025, there's almost no impact on GDP in the US. This process of dislocating the US economy, dislocating production networks, causes capital to change, capital to move around the economy, to move overseas, and that causes the biggest effects in terms of deviation from what otherwise would be the case is in 2026. So we actually haven't seen the tariff effects on real GDP yet. But you can see that in the long run, the GDP effect is permanently negative. So again, this is not growth rates, this is the deviation from baseline. So this says that these tariffs will permanently shrink the US economy by about 0.2% every year from this point onwards. Why is that? Well, because the cost structure of the US economy has changed. The most efficient use of resources was to bring in certain goods from other countries. Now the US will be producing those goods at a higher cost. And so the effects are permanent. It's not a devastation of the US economy. This is not stagflation, as a lot of commentators have argued. It's an economic slowdown. It's also inflationary, but again, the range is between 0.4% inflation in 2025 and 1.1% inflation. US inflation is sitting above 3%. This is a plausible number. And again, this was run last year, so you can actually start to evaluate how good these numbers are. The key driver here actually in the economic adjustment is what happens to investment. Investment drops in the US. Why? Because capital that would have gone into the US economy in these sectors will now flow overseas. And so there will be a reallocation of global capital over many decades. And the investment response is upfront. So firms decide they have to change what they're doing. They reallocate within the US economy, different sectors, and they'll reallocate across countries. What happens to the bond market? Well, this says that long-term bonds will fall between 30 basis points or 0.3% and 0.6%. So this does actually cause a bond market a fall in bond rates. It also causes a rise in inflation. And it causes a slowdown in the economy, jobs lost. Now, what's important here is this assumption in the model that even though you might lose jobs in affected sectors, and I'll talk about what sectors that is in this shortly, the wages will move in the US economy, so the aggregate labour market will eventually clear. So the assumption is over time, after a decade, all the jobs that were lost will be reallocated, and they'll be reallocated with lower wages. So real wages will be falling, and that way all these workers that lost their jobs will be re-employed after a decade. Now, what's interesting actually is what happens in individual sectors. The two sectors that get hit the most in the US economy are agriculture and durable manufacturing. Why agriculture? Agriculture is very trade exposed, and we know China retaliated against soybeans exports, but actually the agriculture is very sensitive to international trade. And also agriculture has a lot of imported intermediate inputs from other countries. So those imported intermediate inputs, whether it's fertilizer, tractors, their price goes up, which means that you get a cost squeeze on the input side and you get a demand decline on the demand side. And so you can see that by 2026, this year, we expect to see about 3.5% fall in employment in agriculture. We're already seeing that. Agriculture employment today, or output in agriculture today is down relative to what it was last year. The other sector that gets hit is durable manufacturing. Why durable manufacturing? For two reasons. One is it's very trade exposed. The US exports a lot to the world economy. It's also imports a lot in the production processes, whether it's from China, whether it's from other countries that have had tariffs imposed. And this causes a permanent decline in employment in manufacturing. Today, there are less workers in manufacturing than there were when the president was elected. So these results are consistent with what we're observing. And ironically, the people that voted for President Trump are the farmers and the manufacturing workers. And this policy of tariffs impacts them the most negatively in terms of employment, but also in terms of the consumption bundles and the cost of living. So that's the US results, and that's not surprising to any economists who are listening, but this just puts you the magnitudes. The key lesson here is it's not the end of the US economy. It's not stagflation. It's not a total disaster, but it's costly, very costly for certain sectors of the economy. Now, China is different. China has the biggest tariffs in this particular scenario. They're around 65% at the point in time in which we chose to do this. What happens with China is actually quite a large depreciation of the exchange rate. Capital flows out of China. China gets hit with a loss of demand from the US market. It takes a while for it to reallocate its production networks into other countries. The trade balance improves. The Chinese trade balance improves because capital's flowing out of China. The exchange rate's depreciating. It's depreciating in third markets, so China gets a competitive advantage in other countries, and that improves Chinese exports, which is what we're seeing, and that entails a trade balance surplus. It's inflationary in China, partly because the Chinese monetary regime is to lean against the exchange rate as well as to target inflation and output gaps, so that when the Chinese currency starts to depreciate, there's a loosening of monetary policy in China to try and lean against that depreciation, and that means that there's an inflationary impulse into the Chinese economy. The GDP effects on China, again, the range is between 0.4% versus 0.8%. So if China was going to be growing at 5% in 2026, this says that they'll be growing at 4.6%. So again, this doesn't destroy these economies, but it does lead to economic losses. And again, the bond market effects are global. As the bond market yields fall in the US, then they fall in other countries. So let me now come to India. And India is particularly interesting because it has high tariffs, as we know, 50% on some parts of Indian exports, but low tariffs relative to other countries in the US economy. It also has a very different production structure. And you can see this, the effective exchange rate of India slightly appreciates in our earlier work at the beginning of the April tariffs, because there was no 50% tariff on India. Indian tariffs was quite low. This higher tariffs came in between April and September. So you can see that the latest numbers are quite different. You now get a depreciation of the effective exchange rate, and if India retaliates, it's overlaying this. This is what happens to the trade balance. The trade balance worsens in India. Again, this is because of the global allocation of savings and investment. India actually attracts some capital that would have otherwise gone to other countries such as Bangladesh, Vietnam, and China, that now moves towards India, and that causes a trade balance deficit. So in other words, investment in India is rising relative to savings in India. Indian exports, as you might expect, go down. They're going down by even more than the original Liberation Day because the tariffs are bigger. So you're losing about 0.6% of GDP exports. Well, interesting, imports under the Liberation Day, imports went up. Under the latest set of tariffs as of September, imports go down by about 0.2%. And it was deflationary slightly because of the exchange rate effects under the Liberation Day tariffs, but now it's slightly inflationary once we take into account the larger tariffs. And interestingly, GDP goes up. So it goes up by a very small amount, 0.05%. This is the latest data. This is largely because of the structure of the Indian economy and the fact that tariffs aren't on services, and services are a key part of Indian exports. You see that the bond market in India is affected by the global reallocation of capital. 25 basis points fall in the 10-year bond rate. And what's interesting here is the sectors that get hit. So here we have manufacturing, non-durable manufacturing. It's hit directly by the fact that it's not exporting as much into the US market. It's down by 0.8%. If you look at services in India, it's up. And that's because there's no tariff on Indian services, and there's a reallocation of imports in the Indian economy and a reallocation of Indian exports around the world. So what do we learn? What are the main insights? It's almost inevitable you get an economic slowdown with higher inflation in the US. The bigger the tariffs, the worse the economic loss and the higher the inflation. Retaliation by countries makes their losses worse and the US losses worse. And the impact on the rest of the world is ambiguous. Some countries gain, depends on how much you rely on the US market versus third markets. It depends on what you're selling to the US market. It depends on who your major trading partners are. So as I mentioned, Australia gains in the US, but it loses from the negative effects from China. And it also depends on how global capital markets reallocate capital, and whether you're a net foreign debtor with lower real interest rates in the world, that's a benefit. If you're a creditor, then that's an economic loss. Now, if there's time, I just want to quickly present another result, which is, I think, more important, in fact, because I think this is what's going to drive the world economy for the next couple of years. One thing we did notice is when you do the tariffs, and I don't think I had the graph, but the exchange rate should have appreciated. It's fairly typical in trade models that if you put a tariff on, it causes an appreciation of exchange rate. What we saw when the tariffs were applied was a depreciation of around 10%. And the way we argue that what was driving that was a loss of confidence in the US economy. And we modeled that as an increase in US country risk of 100 basis points. Now, if in fact investors do lose confidence in the US economy, that has significant implications for countries like India and other countries. So this is what happens then is a different scenario. There's no tariff. It's just all of a sudden in 2025, as a result of the policy dislocations, people require an extra 100 basis points of return on holding US assets. What happens to the world economy? Well, if you require a higher rate of return, capital will flow out of the US economy. It'll flow overseas. Interest rates in the US will go up. Investment will go down. Physical capital will have to generate a higher marginal product to compensate for the extra risk. And the US economy actually has a very significant slowdown. So this is 100 basis points. If it was 300 basis points, the US would be in recession. Notice that countries like India, GDP actually goes up in all these economies. Even though the US economy is slowing down from a demand point of view, the relocation of global capital into these economies will cause their supply side to expand. And so the investment increase will more than offset the fall in exports into the US market. So what do we learn from this? Well, again, the US gets another economic slowdown with higher inflation. The US trade balance improves, which is one of the administration's goals, but it's improving for bad reasons. It's improving because people are pulling their money out of the US and driving down the US dollar. It causes a US slowdown, so global trade is impacted directly. But if a country has open capital markets, the capital will go into those economies, and whether your GDP goes up or down depends on how much you trade with the US versus how much you trade with other countries in the world and how open your capital markets are. And so countries that are receiving capital will deteriorate, the exchange rates will appreciate, and their trade balance will deteriorate. So what are the main insights we get for policymakers? Firstly, don't retaliate to tariffs with tariffs. It makes it a lot worse. The goal shouldn't be to retaliate. The goal should be to, and again, this is echoing Mark Carney's argument, but we wrote this a year ago, was basically you should expand trade relations with the 85% of the world trading system that's outside the US. But be prepared that there will be, if the US economy goes into a financial crisis situation of loss of confidence, there will be a lot of capital flowing around the world, and trade balances and fiscal policies will have to adjust, and particularly if you overlay that with an AI bubble. So I'll finish up by saying this is not all that's happening in the world. So we're seeing the tariffs are working their way through. There's a very large fiscal stimulus in the US. There's a very large investment boom in the US coming from AI and the support for cryptocurrencies. These are all having big impacts in the US and spilling over to other countries. There's also a lot of missing workers. There's 2 million missing workers in the US in 2005. That should be 2025, sorry, because of the deportations and the lack of migration coming in. And we know that the Fed independence is still under threat. Overall, then, I'd expect 2025 to be fine. 2026, we'll start seeing the damage come through, but the serious damage, if you believe these results and our other work in this area, will be in 2027 and 2028, unless there's a loss of confidence beforehand, in which case we'll start seeing the impacts. And again, the dashboards are available on that website that I mentioned. So thank you very much. I'm happy to take questions.
Thank you so much, Professor Warwick, for your, very insightful, analytical, presentation. Now, I think I like, Professor Biswajit, the discussant for today's session. So, to critically, examine the entire thing, and then I think, we'll throw two questions to the, to all the invitees and those who are attending, all the participants. So I think Biswajit, please carry on. Acha, let me tell you that Biswajit is my colleague and he is a very celebrated professor at IFT. Carry on, Biswajit.
Thank you very much, Warwick. Can you hear me? Am I audible?
We can hear
yes,
you.
Yes, I can
Please
hear you. Yes.
So, first of all, I'd like to congratulate you. It's a very good, model. I was just looking at going through your the documentation part beforehand as well. So the comprehensiveness and the nuances, the way you have done it, perhaps in a dynamic general equilibrium model. This is the first time I'm seeing you are bringing so much of things, and this was a question in my mind of when the United States started having differentiated tariff in such a at a disaggregated level with different countries. Generally, most of the time in general equilibrium model, we try to aggregate as well as try to make it simplified, but you have made an attempt to have different tariff rates for different sectors and also for different countries. Okay, I think that's a lot of work. I think your colleague must have done and spent days and nights to put the database together. Okay, so so that said, I'd like to thank that. This is excellent work. And of course, any trade modeler will have to look into the time period. So you have rightly mentioned that you have data till September 2025 and many things have changed. But whether the model is able to predict 2026 and onwards, like 27 and 28, that's the thing to see. But a lot of things are already in place. And I think, the predictions, what you have made, are more or less coming in the same line. So let me just look into some of my observation, because I do not want to discuss much on the technical part of the model, because you have also not discussed on the model, but some of the interesting observations what we can see it. First of all, we know the percentage changes in GDP. And we have, and you have also compared between China and India. So there are, in the slides, there are several countries, but we found that India has a small positive, like a green shoot. You have a red shoot here. Okay, so small positive growth, but most of the countries are actually having negative. One interesting thing that your model has not considered the tariffs on services. So India is a major exporter of services to United States. So possibly the positive growth with the India-US trade coming through that. And another sector like pharmaceutical, on which United States decided to remain indifferent against India. So there is no additional tariff coming on this, because this is a part of their priority. And United States generic in the market, the generic drugs are mostly Indians. So that's basically one of the India's important thing. Sometime back, I looked into the monthly data of US import month by month. And what an interesting thing I observed, because we are a labor intensive producing system, production system. So we expected that the labor intensive goods like leather and textiles, their exports will go up. But even before the tariff hike, what we are noticing, there is a structural change happening. India's exports of electronic goods to United States, machineries to United States are increasing. And on the other hand, the exports of leather and textile are actually almost constant or maybe sometimes negative. So I'm sure that in your model, if you really would like to write a paper on India specific, because the model may be, is a holistic, generally curriculum model. If you need to pull out the results of some of the sectors, perhaps these sectors would be very interesting to study, that, how these sectors, which are India's important sector, how they would be moving forward. So that's basically the one thing I'd like to say about the possible, rise of GDP in terms of positive growth vis-a-vis China. Your observation on Australia was quite, important, because as US slowing down and China also slowing down, so for Australia, perhaps the slowing down is dependent on Australia's export market is actually going down because China is slowing down. Your another observation, which is very important, I'm sorry, another important observation is that you mentioned that, other than US, if the economy is trying to focus on that, then perhaps some of the losses in the US market can be diffused. And you mentioned some number around 85% market. So if you look at India, in recent time, India actually signed several free trade agreements. For example, with EU, UK, UAE, New Zealand. Okay, so a lot of such, other than US economy, India would like to engage itself more intensely, and that's important. But I have a bigger question here. India is not so much linked with Southeast Asia's value chain. You mentioned about the value chain effect also. But here what is happening, like other countries in Southeast Asia, they were having an extensive value chain with China, Japan, and Korea. India is not so much integrated with Southeast Asia. So it requires India to re-look into this particular strategy, because the market is here in Asia, and most of the countries would be having positive growth rate in coming days, even for 2027 and 2028, as we have mentioned, that in our US economy may go into recessions and a long-term recession, perhaps. So in such case, what happened, looking into Asian market is extremely important. How India as a large country will be facing a lot of competition. I'm sure other countries like Australia, like China, like Japan, Korea, they'll also look into and explore the Asian market. So Asian market will be very, very competitive in the coming days. Okay, so that's my second observation. And so one side, if you look at now, the world is now divided. One is a US market, another one is a non-US market. Okay, so when you are making a policy, so if US continues to have high tariff, then there is a possibility, even without having an intention to do it, it's quite possible that countries, those who are actually exporting to the United States, slowly will move out of the United States, and other markets will be explored and created. So if GDP growth rate from other part of the world goes up, so most of the countries will start exploring those markets. So that's another observation which I'm having. So in such case, what will happen? The US, recessionary trend will go on. You have rightly identified that there is two effects. One is the high tariff effect, and second one is basically the value chain effect also, because imported raw materials as well as intermediate goods will also be costly. So I don't think US will be able to continue with the high tariff for a long time. And they will be doing some more, interesting possibly cuts and, maybe much more nuanced strategic approach towards the tariff. And that will make the model more complicated. The last point, which we'd like to mention about the sentiment and the geopolitical issues. This is my question actually: how you dealt with that? Because those are much more qualitative. Maybe you have supply chain disruption. Maybe you will be considering the numbers going down indirectly. But if there are some new tensions coming up, how the model will actually be able to absorb that? That's basically my main question. Otherwise, from the economic point of view, from the model point of view, it looks fantastic. The results are quite coherent and consistent. But if you are able to throw some light on the geopolitical issues and supply chain disruptions, how actually you can bring that in the model, that that will be great. The last point, in fact, this is one of my concern about the CG structures, the standard CD structure. And some time back, I was telling to one of my friends, you must be knowing Ben Shepard. He was also developing some model on this. I said that these models mostly work on multiplier, as well as basically the coefficients, and through which we try to get the elasticity. Now, the elasticity, does it work in the same way when the economy is going up and going down? So, so most of the time we take the same elasticity. Okay, so the models are tested in good times when elasticity values are positive and giving a boost when you put a shock. But does the same elasticity work when the economy is going down, or the elasticity value should be considered as a dynamic? I do not know whether you might have treated this in your model, but if you are able to tell us, that will be great. Otherwise, thank you and congratulations once again.
Thank you, Biswajit. Professor Warwick, you want to, elaborate upon what have been discussed with Professor Biswajit?
That would be great. Thanks, Professor Joshi. Yes, and thanks, Biswajit. A lot of questions there. Just on the geopolitical risk, it is interesting. So the way we have this type of intertemporal general equilibrium model, where we have financial markets and the real economy interacting with each other, we do have sector-specific risk premia. So we have risk premia between equity and bonds within different equity classes in different countries. We have country risk premia. So we can actually hypothesize how geopolitical risk might impact on a sector or a country and shock those risk premia in a scenario form. So basically, yeah, the model is largely used for scenarios, different questions. How do you model the scenario? And so geopolitical risk is a big one. What if there's a war between the US and Iran this weekend? Well, we actually have modeled war scenarios in the past, the Iraq war, for example, and other ones. It's hypothetical, but you can do different types of interpretation of how markets might respond. The point about services, that's a really good question. So as I mentioned, in the work we did before the election, we assumed that it would be a uniform tariff of 10% on all goods and services in all countries. In that case, India gets hit quite badly because the service sector gets a tariff in the US economy. But the difference in this scenario is that it's only goods and it's not all goods. It's, as you mentioned, pharmaceuticals are exempted. There are a few goods which are built into the effective tariff rates. And so it does matter what the tariffs are, what's exempted, who you're trading with, who your production networks are with, and actually, importantly, how your country responds. So the worst thing that India can do to these tariffs is to levy tariffs. All it does is make it worse. And so the model's fairly robust on that sort of conclusion. A final point, it's a technical question you ask about elasticities. One of the things that's important, why G-cubed is not a CGE model. G-cubed has adjustment costs in capital accumulation, and it has an arbitrage between the real economy and the financial markets. So what's driving bond markets is related to liquidity. It's also related to adjustment costs. And so when you talk about an elasticity, that's the deep parameters that we have in the model are down inside the consumption utility functions in the production functions. So when you do a shock, there'll be a short-term impact. And depending on how the capital stock changes in different sectors, there'll be a different long-term impact. So it depends if you're interpreting the deep parameters as elasticities, or you're talking about how does something change in the long run relative to the shock you've done. They're different. And they're different because of this physical rigidities in the economy coming about from the physical capital side versus the flexibility of financial markets. That's one of the key characteristics of this model that makes it quite unique. It looks like a dynamic stochastic general equilibrium model, but the reason they published it in the handbook of CGE modeling is because in the long run it looks like a CGE model, but in the short run it doesn't. There's unemployment, there's rigidities, there's volatility, and so it's a longer discussion, but yes, the website contains answers to most of your questions, and as I said, it's a public good, so anybody can access it. You can even access a two-country, two-sector version of the model that you can run yourself. The full commercial versions are sold through my software company, but it's great for teaching a course in the world economy, which is what I and others use it for.
Yeah, that's great. Thank you very much. I think it will be very useful. I will have much more detailed, discussions maybe later on with you. Let me just go through the model 1 second, because I just had a quick glance, but you have rightly mentioned about short run and long run effect. That's very interesting to say. Okay.
Thank you so much, Professor Warwick. Now, any questions? Anybody want to have any questions? Please put your question on the chat box, so we'll be able to take them one by one. Any questions?
Mr. Chairman, yeah.
Please.
This was very interesting and very absorbing and masterful exposition from all three of you. And how you say this impact on the US economy will be felt 2 years down the road. By that time, perhaps the Trump himself will disappear from the scene. So will it be, you think it will be felt during his tenure, or much later after he leaves the office, Oval Office? What's your...
So that's a good question. So ironically, if you look at a lot of the different scenarios we've looked at, a lot of the policies are created to have a boom now. So the fiscal stimulus stimulates the economy now. The relaxation of monetary policy, if the Fed is compromised, that's a liquidity shock now. And those shocks eventually have to be paid for. So you go out to another 2 years from now, and a lot of the negatives are in actually 2028, when there'll be a new election for the president. So if no crisis occurs between now and then, because we are creating chaos, if there is no crisis, then whoever's going to be running for president in 2028 is going to be inheriting a quite weak economy with a lot of government debt, with a high inflation rate, because the Fed will be ultra loose. It could be saved by the AI boom if it's real. It could really be a productivity surge coming at that time, which could offset it. I'm skeptical of that, but it still could be possible. But yeah, the irony of this is that economics is driven by the policy, by the political necessity to push the US economy as quickly as possible and to make as much money as possible in the short term before things fall apart. So expect a party and then expect a hangover.
Yeah, one follow-up, small corollary of this. I mean, this is a follow-up, not strictly the economist question on economics, tangent, but it is related to that. Now, do you think that the FTA entered between USA and other countries such as India and others are influenced by not the real negotiation, but influenced by his act, what he did in Venezuela. Because few writers, the political writers and the journalists are writing, people are getting the FTA even if they don't like in the national interest, because what they see, the small country particularly, has happened in Venezuela, influences their reluctantly entering into FTA.
So again, I'm not a political scientist, and I don't want to speculate too much, but I think the reality is that people have lost trust in this administration. So any deals that are done don't have to be developed, don't have to be delivered, because the US this week is a different deal for next week. And so that's undermining, a very deep undermining of international institutions and international trust. So this is a much deeper problem than just tariffs and simulations in an economic model. This has some very far-reaching implications that are outside the scope of what a model can do. But it's very disconcerting what's happening in the world at the moment.
Okay, thank you. Now, I think there are questions in the chat box. I can see one interesting question. With the permission of chair, can I read from the chat
Please
box?
carry on, Professor
So,
Ashok, carry on.
This question, I think, by Ajit, why Trump is following such policy which can harm the US economy apart from the worldwide disruption in trade? Is he using tariffs to achieve political objective? Now, this is any one of the chair or the panelists can answer this. Very interesting
Well,
question.
I think basically he has advisors that think tariffs are a good idea. They have a view of the world, which they've convinced the president is the way the world works. I think most economists, and including myself, think that they've got that wrong. And they're discovering they've got it wrong because the economic data, if you look at the job losses in agriculture and manufacturing, you're not getting a resurgence of the US economy. You do have higher inflation. So I think that's part one, is that it's a misunderstanding of how the world works. But part two is enrichment of the political class in this administration is number one goal. And while you can enrich yourself as quickly as possible by doing deals, that's what's driving it. I don't think the well-being of the US people and the US economy is the focus of the administration at this point.
Yeah, then there is another question by Asha Galian. A neutral approach to global market fluctuation is really important. That is why exploring different markets becomes an important step, not in the short run, but in the long run. So I think this is more an observation. If you want to respond.
Well, I think one of the lessons of this period of history is diversification is a really good idea. James Tobin won a Nobel Prize for that insight. But yeah, diversification, when there's uncertainty, when there's higher risk, diversification, even though it's more costly, gives you a payoff in terms of reducing the uncertainties. So I think this effect will be permanent. I don't think if there's a different administration in 2028 that everything will go back to where it was before this administration. This will fundamentally change the production decisions of companies. It'll change the political decisions of governments. We are in a new world. I think there is a disruption. And I think that there's going to be, again, makes it interesting for modelers because we have to deal with severely different structural change. But it is what it is, and so we'll adapt to that.
So there is another question. Should India focus on getting more FDI from US firms at a time Trump is threatening US firms investing overseas with penalty? So your take on this?
Well, again, I don't see why you would want to focus on investing income from the US. Basically, if your economy is being well managed, if there's great opportunities, the Indian growth experience is highly positive. Money will come flowing, whether it's coming from the US firm or somewhere else. It's seeking out investments from rogue countries is not a good idea. It's creating the environment where it will attract capital based on the expected rates of return. So again, I'm not a political scientist, I'm an economist, but I think the idea that the US is going to be attracting capital into the US economy as part of a deal, well, we know that's not working because the US dollar is depreciating. If capital was flowing to the US as a part of this arrangement, the US dollar would be appreciating. So more money is leaving than going in. And I think that's a lesson for most countries. Don't do deals to get firms to come into your economy, create the environment where the rates of return, the political risk is low, the rate of return is covering the risk. Then that's a much better strategy than trying to seek out investments. I think they'll be forthcoming with the right legal regime, the right political regime, the right financial system, rule of law, etc.
Yeah, so the question have been addressed by the panelists and chairman, if he wants to, Mr. Chairman, you want to say some concluding remark, Professor Biswajit also, any remark, concluding remark from you, distinguished panelists?
Thank you so much. And I think most of the issues have been covered. So I think Dr. Vetia Nadani, you want to say something? Please. He's raising the hand. Carry on.
Observed. Thank you. Well observed is very good message for me also. I learned a lot. Thank you.
Okay. So, because the whole discussion was extremely contemporary, and what Professor Warwick has said is that, what he, forecast is things will not remain the same in time to come. And then companies' strategy would change, with the time to come, the production, destinations will change, the FDI will, the attractiveness of, US and many different countries will change, and the supply chain network, which is presently, or the production network, what is there, is going to change. So I think my only concluding remark is the whole world now has to prepare themselves for this turbulent environment and time of uncertainty, and keep updating our strategies every now and then, because I think something which is going to remain unchanged is change, and we are going through a big uncertainty. But one thing that you have seen from this, that certain countries have done really well. It impacted multiple countries, and it was a very, very comprehensive presentation where multiple parameters researched thoroughly, and research with great dedication, and it was very difficult to have so many parameters for his research. So it was a very, very thought-provoking and insightful presentation, and the discussion as well. Thank you so much from my side. Biswajit, you want to say something?
No, it's I really like the presentations. I will read the model.
Very much.
And I'll get back if I have any other query. But this is a very interesting way to see it, and this is a very interesting way to model it also, because quite a complicated database has been prepared, which can be used for many purposes, and we can actually pull out through new shocks for any effect on any country, for that matter. When India signed FTA with the United States, which is outside the database at this moment. So if the database is extended, then we can actually try to relook into the possibilities how India's growth will be affected by this new regime.
Very good. Thank you.
So thank you very much, all these three distinguished panelists. All good things in life come to an end. Today's webinar was no exception. It was so absorbing and so useful, and so it aroused the curiosity of many, and certain questions I'm sure many others might be having, but because of paucity, we really confined to only few questions. That is one. And whatever today we discussed, that will be available by tomorrow forenoon on our website, that is by EGROW, for everybody to see. We'll present the recording. I mean, we'll upload the recording on our website for everybody to see, and we will send what is discussed today to the ministry that matters, such as Ministry of Commerce, Ministry of Finance. We'll be sending them what we discussed today, so that they can take note of whatever they want to take away from today's discussion. So thanks indeed on behalf of EGROW Foundation and on my own behalf. I thank you all the esteemed panelists, Professor Rakesh, Mohan, Joshi ji, Professor Warwick and Professor Biswajit Nag. And this discussion would have been incomplete if there was not enough audience, the panelists, the people who ask the question, their contribution is no less important. And I'm sure there are many who will be looking at the video recording of this. And tomorrow, the next Friday, we will again hold the webinar. And this we have been doing very religiously these webinars, 250 plus. And we'll announce the time and the topic on in a day, but then it will be on Friday. We'll be sending those details. So with these few words, I thanks once again from the bottom of my heart to each one of the panelists and the audience and everyone. Thanks indeed, and have a great weekend.
Thank you. Namaste.
Thank you very much.
Thank you.
Thank